Hey, what's going on, everyone? My name's Andy. My channel is Finding Value. Today, we're going to go through Twitter, see what people are sharing on social media like we normally do every day. I'll share my opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look and see what people are sharing on social media. If you want to follow me, it's at Finding_Finance. And if you want to join our community, findinghighvalue.com, where I dive deeper into these topics, into individual companies, how I'm playing the commodity bull market. You get to see my portfolio, what I'm buying real time is on there. So if you're interested in joining, we still have a coupon code MAYDAY, MAYDAY, that is still active. You get 50% off the first month, only the first month, or you get a larger discount on a yearly membership if you'd like to join for a year. So Warren Pies, he says rates are down equals buy every S&P 500 micro dip. Until recession threat is more real, this playbook will stick around. The stock bulls can thank oil. And that oil had pulled back here recently, which I think brought yields down with it. Yields and the price of oil are very closely interconnected. So whenever oil goes up, it seems like yields go up, and vice versa. When oil goes down, yields go down. And since, at least in Warren's opinion here, he doesn't think that the recession is a recession threat is really here in the short term. We could see stocks go higher if oil goes lower and rates come back down a little bit. Game of Trade says every time this happened in the past 50 years, it has ended in a recession. And this is existing home sales falling here. The only thing that I would say that is different from all of these that he has projected here, this was a housing bubble where we built too many homes. This was a housing bubble that we built too many homes. This was a housing bubble that we built too many homes. These are all hyper-supply phases of real estate. The only one that isn't, well, there's two here. This one here isn't, and this one here is not. We did see a pullback in the real estate market in 2000, 2001. So that did occur in new housing starts, but we don't have the same conditions right now. But we do see this pulling back, and I'm sure that there is a slowdown in home sales, and that is impacting a lot of people that deal with the real estate market. But we don't have the inventory of existing homes like we did in the majority of these instances, is what I'll say, is a big difference. I mean, it's a colossal difference. Our inventory levels are actually lower than they were in the beginning of these boom phases in every single case in history. We are still that low in inventory today. North Star says, is it possible for silver to outperform the S&P 500 by 1,600%? And obviously, when you're looking at ratio charts, silver could go up while the S&P 500 goes down. But we've got a potential, oops, I wasn't zoomed in. We got the potential for a breakout here. We saw a big rally back in 1999, going all the way up to 2011, it looks like. We also had a monster rally in late 60s into the mid 70s. In the mid 70s, it just took off. So I think that we're really early still, and a lot of these commodity sectors and groups haven't really made a lot of progress against the S&P 500, against the Dow Jones, against a lot of the financial assets yet. And we're waiting for that money rotation. And the money rotation occurs when silver starts to outperform the S&P 500. So what you'll see first, kind of the first stages, is that silver starts to break out against some of the other assets like gold. And then silver will most likely break out of its US dollar chart resistance patterns. Then it will start to break against these other ones as it gains steam and as other asset classes may start to underperform. And then you start to see a big rotation of assets. Money chasing price performance is really what it is. Can we go all the way to the top where he's got this line here, which is 1,633% higher? And that's going to be a combination of the S&P 500 going down and silver going up, in my opinion. And yes, it is possible. I will say it is. Gorian Rosenzweig says, why today's oil market feels similar to the bullish setup in 1970 and 2003. So let's go back to this chart. Look at 1970. 1970 somewhere in here. And 2003, we had silver breaking out already against the S&P 500. So we're still probably in similar areas of this. This is probably 70 here, maybe, and this is 2003 would be over here somewhere. So it does look like this matches exactly where they say we're at. And he's talking about oil market. What gap accounting can teach us about the energy transition, why we believe the uranium bull market has further to go. So these guys are remaining bullish. They're looking at the fundamental picture. I know we've had some strong selling pressure in commodities the past few days. Obviously, it doesn't feel good. But yeah, they remain bullish, and that's their opinion there. I got a couple of quotes here. Peter Lynch, opinion on market timing. So he says, I can't recall ever once having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made billions by doing it. There are some people, Jesse Livermore, he's the most famous trader. He made a bunch of money in short periods of time shorting the market. They called him the boy plunger. But he went bankrupt a whole bunch over his lifespan. So he made all this money, went bankrupt, made all this money, went bankrupt. So it's not a reliable way to try to market time, because really what it ends up being is just gambling. And then you put a large bet on and you win. And it's kind of like a statistical probability that sometimes you win and sometimes you lose. And these guys lose all their money. And they do it multiple times. It's kind of like they kind of just have that gambling mentality, perhaps. But the more reliable way is to adopt the Peter Lynch, Warren Buffett approach, which is buy the value in the market and then just sit and wait. And that's the approach that I've adopted, instead of trying to go boom and bust every every market crash and every market movement up. I've got another one too. This is Timing the Stock Market with Warren Buffett. It says the real fortunes in this country have been made by people who've been right about the business they invested in and not right about the timing of the stock market. So both of these guys, who I would consider to be very successful investors over long periods of time, they've been outperforming the markets for many years in a row. They believe that you can't time the stock market. They believe that you can't time the recessions. They believe that if you buy the right businesses and they're undervalued, that's where you make a lot of the money. You want to buy when there's fear in the market, but you can't necessarily time it. So these guys may carry some cash. They may do something and wait for those opportunities to deploy large sums of cash. I know Warren Buffett does that a lot. And he waits for a crash or a potential fear in the market, and then he deploys a bunch of money. And he's really good at taking the emotional counter trend move from everyone else. And he makes a lot of money doing that. And that's when he buys, is when you get that big valuation gap between the value and the price of the stock. Unusual Whale says 18.4% of U.S. single-family homes that sold in the first quarter were purchased by investors, the highest share since mid-2022 per Redfin. Why are investors buying all these homes, guys? Is it of good value, or are they buying at a market top? I highly doubt they're buying at market tops. But I don't know, that's the data there. Kobayashi letter says, oil prices crashed nearly 10% in 5 days over fears around weakening global demand, is what I guess their opinion is. Even as OPEC just extended oil production cuts of 2 million barrels per day, oil prices are nearing their 2024 lows. Recent data suggests that the U.S. economic activity in manufacturing and construction is slowing, a recessionary sign. As a result, oil prices are down 16% from their April peak and up just 3% year to date. Markets are not buying the soft landing narrative, is what he is talking about. We got Logan here. It says a visual going back to 1968. This is the United States existing home sales. And you can see where we're at and how far this has come down in existing home sales and some of these other large movements. We've had a pretty big movement in existing home sales compared to recessions of other times here. So it is pretty big deal of how much this has fallen in existing home sales. The thing is, home sales, existing home sales, they don't necessarily drive or crash the market. Inventory does, where there's a lot of pressure on, it's not sales, because sales is a function of sales volume. So what we're looking at is the volume of sales. What we need in a crash type scenario is credit destruction, which is not equivalent to home sales. Credit destruction is when home prices go down, people who have loans against their homes go underwater, which means that they owe more in the house. They owe more than what they actually have for equity. We are in the same situation as we were in 2007 or 6. There was a lot of loans that were foreclosing, going through short sales, and there was a lot underwater. We're not in the same situation. So the volume of sales have declined, but the fundamental structure underneath the housing market, in my opinion, is still very strong for the residential sector. Intraday volatility can be vicious for commodities and metals, but it's important to step back and look at the long-term charts. Silver is a great example. The uptrend is still intact. $28 an ounce should act as a new support level and would be a great spot to add, in his opinion. And I agree with that. You have to take this from a big picture view. We've broken out, and now we're getting that retest move. That's where we're at. U.S. existing home sales by year, and you can see how low that we are in 2023. And look at what Goldman Sachs is forecasting. Lower existing home sales going forward in 24-25. So maybe they think that interest rates will remain elevated and that sales will remain depressed. That's kind of how I would view this and guess what they're kind of estimating. JC Parrott says next week's marks the 2-year anniversary of this bull market. Does it still have legs? New York Stock Exchange broker-dealer index rolling higher. Semiconductors rolling higher. Industrial XLI rolling higher. And then home builders are also rolling higher. Maybe we do a retest here, which is a potential there because I watch XHB. 1999.com bubble was so cute. You can see the bubble here. And then the monster bubble that we've got going on today. Absolute ripping. The 5 largest companies as share of the S&P 500 total market cap is 27% right now. The last bubble was only 18%. So here's silver. This is my buy zone in his opinion for John. I just like the chart. You can see that we've broken out of this resistance region and we're above that resistance region, and we're probably going to come back and maybe retest the big resistance region is what I'll call it. So now it's a support region as we come back. But I just like the view of this chart. Peak bearishness returns to the oil market. This person says, I think we are seeing peak bearishness in the oil market again. We do have a really cheap ratio, and I'll share that later. Says, I hear all sorts of analysts calling for an imminent correction in silver. Mind you, they've been saying that since it was $26. All I see is a perfectly healthy consolidation above the breakout level of $30, which is bullish. Yeah, that could very well be the case. And, there's a lot of people that try to time the short term here. We have lots of charts and a lot of people trying to chart things, and they kind of throw, some lines on there. there's some support through here in the $28 range. And then they try to time the short term. I don't try to do that. I just ride things. And then I try to accumulate on pullbacks. I try my best in the short term to get the best possible price, but sometimes you're going to be wrong. In the short term, if you're really good, you'll get 60%, 70% at best percentage right, and you'll be wrong 30 to 40% of the time. It'll almost be like flipping a coin. So I don't mess around with the short term all that much. I try to time my purchases at really good entry points, and then I just sit and wait. A lot of these guys, they worry so much about capturing these short-term moves. I think the big picture kind of eludes them, which is this picture up here. It's like, so I bought a lot in, what is it, 2018, I bought all this down here. And I've been holding since this time frame, just been holding as this keeps going on up. So I'm up quite a bit. I had my pick of whatever I wanted because nobody was buying down there. And this is the big picture view that I see. That's what I focus on. I focus on this big move that's coming. Everyone else, they don't even look at that. They just look at the short term here. And I just don't think it's worth the effort and the frustration and the I'll say it's really hard to time the short term. So I don't try to do it. I mean, I try to do it for my purchases, but it's really hard to time short term and make it a living at it. The longer term is where you get the higher probability of success if you stretch your time frame out. Bullish trend says, again, OPEC may just not bring back barrels to the market if conditions are not there. And this is OPEC here. It says it's important to note when it comes to 2.2 million barrels per day, monthly increase can be paused or reversed subject to market conditions. It is not a straightforward thing. We've got Scotia here. It says we still anticipate quarter 3 2024 to exhibit the highest supply-demand deficit quarter of the year for global oil supply and demand, and believe oil prices will follow higher. So they anticipate quarter 3, which is like right in front of us, will exhibit the highest supply-demand deficit quarter of the year for global oil supply and demand. So they are anticipating that we're going to have deficits, we're going to eat through inventory, and that oil prices will go higher. So we've got some bulls out there still, at least. Josh Young says global oil inventories have started to decline per Kepler from an already low level. So global onshore crude oil stocks begin to decline, down 50 million barrels since peak, according to Kepler data. While the oil price movement has been wild, the physical market has started to bottom out, which means we're going to start eating through some inventories. This is what Cuppy says, TOP at top, and we're signing. This is the CEO of NVIDIA, and he's signing all these, I think that's in Taiwan, signing the people's shirts, I'll say. Warren Pies says, once again, I'm seeing analysts assume the oil price collapse is a recessionary sign. It was not last year, see below, and it is not now. It says oil, the biggest misread in oil markets this year has been associated every sell-off with a recession / it's almost 100% positioning and supply driving price. These are signs of econ deceleration, but the fall in oil price, in his opinion. Okay. Game of Trade's default rate on consumer loans have now hit the highest level in a decade. Such aggressive rises have systematically ended in recessions since 1987. At this rate, history is about to repeat again. So he's got 1990, 2000, 2008. Now here's the thing, in all of these outside of 2000, this was a real estate crash. And this was the shutdown, a forced shutdown, which I don't think we can include. This is the only one where we had housing starts drop, we had construction unemployment drop, or construction unemployment go up, I should say. 2000 was kind of a different bear market versus some of the other ones. But we don't have the same conditions as 90, and we don't have the same conditions as 2008 in terms of a real estate cycle, credit kind of slowing down from the real estate cycle. that is different for this section now. And this is housing starts are just above average. And then I wanted to correlate this. So 90 and 2000s, before 2008 and before like 90-ish. So here's 90, and you can see the housing starts just fell off a cliff here. Then we had a recession. So we came up and we peaked in 1980, 1987 we peaked. And then from 87 forward, we declined in housing starts. Then you had your recession. You can also see we peaked in the early 70s and the mid to late 70s. So we had the decline, recession, decline, recession, decline, recession. So a lot of these, like 2005 and 6, we had a strong decline in housing starts, which ended in a recession. We've declined a little bit since 2021, perhaps up here. We've been moving sideways and just chugging sideways in housing starts. To me, this looks very similar to this area in here, like we're in the 2000s where we're just chugging sideways. You could even say maybe the 60s where we chugged sideways for a while. We even dipped in the late 60s, but there was no recession. I think this is similar here. We have housing starts that are kind of around the average, and we haven't really built all those homes yet and gone into a large expansion phase of real estate. Peter Schiff says this morning silver's down over $1, trading below $30 for the first time since breaking above it on May 17th. This could be the final shakeout in silver before it moves to new record highs, just like the final shakeout in gold when it traded back below 2K on February 14th. So that's Peter's opinions there. Patrick Karam says great opportunity for platinum morphing into existence, and I agree with that. Stay clear below this 16-year breakout line. I purchased a whole bunch in 2020 and a little bit down here in 2019. And I purchased a bunch over here as well at these low points. So I bought it all kind of in this low area down here. This is below the cost curves of the platinum group metal producers. The only thing that platinum was kind of lagging was platinum's not the huge driver of what they sell, because they also sell a lot of palladium and they also sell rhodium. And at the same time, in this general area, palladium was very high and rhodium. So they could still make money based off of those. Right now, everything is cheap. Platinum, palladium, and rhodium is all cheap. So I think that the mining companies are actually pretty good entry points down here. And I think platinum, since it's based out, is ready to rip. We're also above this big volume, I'll call it volume node. Massive volume defined base, which is the base underneath here. Sahara says, this is for silver. How's it looking? So we've got this, I'm just going to go straight to the chart here. We've got this pattern that he's got, kind of a downward channel that we've got going on. And we're real close to breaking out of this channel. And then he's got price objective moves moving on upward based off of this flag pattern here. So it looks good. We just got to be patient, wait for all this to basically play out. We've got Grady here talking about silver as well. It says the big silver breakout level using the yearly time frame is 31.32, and it is now right up against that breakout level. The blue tightening arrow pattern means a breakout is a given. Means one of the most significant breakouts in history is incoming. Get prepared, according to Grady here. And this is a big cup and handle that we're breaking the top of that cup and handle pattern right now. If we close this year above 31 or 32, it means that we have activated the pattern. It is good to go. And here's another one. This is another one from Grady. He says the move in precious metals miners have only just begun. The charts are now set up to climb the right side of huge arcs. Rounded bottoms, cups. Most will not get into a bullish mindset until it's too late. Do everything you can now to get prepared mentally for what is coming in the gold and silver mining space. So remember, we've broken a lot of those patterns in silver and gold to the upside. The miners haven't, we're starting to break right now. The miners haven't had the big move yet, and people almost always chase price. They don't chase chart patterns like a lot of us do. So we should be getting long in a lot of these mining companies and just sitting in them, waiting for gold and silver and a lot of these precious metals to continue higher. and then these guys will follow. So what he has, in his opinion, is a massive rounded bottom arc cup in the making, ready to climb the right side of it. It's going to be very bullish here, in his opinion. Here's crude oil. Crude oil is at 32 barrels to 1 ounce of gold. Historically, a really cheap ratio. It doesn't mean it will reverse here, just saying it is cheap at the moment. And 32 to 1 is really cheap on a historical basis of crude oil versus gold. Doesn't mean that it can't get cheaper. I'm just stating that it is very cheap and we should be watching it. So here's Kevin Bamberl. I was going to read through this, so let's just do it real quick. He says the U.S. government broke the convertibility promise first on its own citizens fully in 1933. Then they broke the promise to foreign governments in 1971. Over that time, the dollar lost 99% of its value versus gold. The promise of maintaining inflation at 2% is another out-and-out lie by the U.S. government and Federal Reserve officials. As increasing numbers of people the world overcome to understand that this is a blatant lie, they will be seeking to exit U.S. treasuries and U.S. currency. The more people head for the exits, the more worthless the dollar becomes. The more a trickle out turns into a stampede. Gold moves from $20 to $2,000 an ounce, or a 99% loss over the last 100 years. Would it have seemed a crazy prediction to make back in 1920s? Just like predicting the next 100 years will see another 99% drop, $2,000 to $200,000 an ounce for gold. But I think that's more likely and could happen in half the time, so it's hard to predict. But for young people, just know that this is the path gold will likely take, and all of your investments need to be benchmarked against gold. Silver is one that I believe will surely outperform gold, as it has many important uses in the economy, and its prevalence in nature commands a much higher silver to gold ratio. Plus, the cost of production is certain to increase. The only question about this trade is trying to predict the ebb and flow. Will gold run to 10,000 this bull or 20,000? Will silver pause at 100 or $200 an ounce? Tenfold increases for good bull runs have a precedent, but they can also prove to be even greater, and there's been a history of many currencies being decimated with hyperinflation. So what's to save the USD when it loses its reserve currency status? This isn't the type of gamble I want to play, but it seems 99% of the population is currently content, as very few, often said to be less than 1% of people, have more than 1% of their investments in gold and silver, despite even mainstream financial education recommending 5%. When precious metals take off, that 5% weighting will save people. Those with high weightings will become very wealthy. I agree, and I have a high weighting. I'm more towards the 20-25% is my weighting, at least. And here's something to talk about too. He says it's probably nothing, obviously joking. It says just in $517 billion in unrealized losses hits U.S. banking system as FDIC warns 63 lenders on brink of insolvency. And look at the lender of last resort. What is this in 2023? $3.6 trillion. Let's take a look here. 2008 doesn't even come close to the 2023 crisis. The great financial cover-up in 2023, and it's still going on, much worse. And this is the lender of last resort. And he's got this big jump of $3.6 trillion. And this is the Dow Jones Industrial Average Index. I don't know why it says that up there, but it looks like he's posted something here. Millions of US dollars, something with it. The Fed's balance sheet, I guess. Coming on back. We got here, the alarm bells are ringing, but will anyone listen before it's too late? Historically, yield curve inversions have consistently preceded economic downturns and financial system turmoil. This chart clearly indicates restrictive Fed policy posing serious concerns for risk assets. But we're still okay. We haven't come up above that zero line. But they generally do precede potential slowdowns. That is true. But having trying to predict when it will exactly occur, most people get that wrong. We don't know when that will uninvert. So today, the U.S. Department, okay, I already went over that last time. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And that's all I've got for today. So we'll catch you later. This is Finding Value.